Everyone, and welcome to another feature video with Nidal Rasheed. And today I'm going to be walking you through a duplex property. So as you'd see in the title, this is a opportunity to buy two houses on one block. There is the potential to create an equity uplift, to have a positive cash flow property, and also get the tax benefits that you'd expect from a brand new property. Now, the property that I'm about to show you is actually a two-pair duplex. So it's got two houses on one block of land. So this is what the frontage would look like. You generally have one house on the left, one house on the right. There's two garages in the middle with the doors coming in from either side. They've got a shared driveway, and I will show you the floor plan, but they're two three-bedders. So basically on each side, you're going to get three bedrooms, two bathrooms, two car spaces, and a single living area on each side. So the property that I'll run you through is actually on an 800 square meter block of land. The land price is $197,000. The house is going to be 265 square meters, and it's going to be 402,980 on the build. So that's for two houses. So basically, you're looking at about 200 grand per house. And comes in at a total fixed price of $599,980. So you're basically paying just under $300,000 per house. Now, the way these look is you're actually getting two houses on one block. So as I illustrated or highlighted in the earlier part, is that you've got the two houses facing the street, and what you've got is a firewall down the middle which separates the two residences. So I'll run you through the one on the left. Basically, as you come through the entry, you've got the main bedroom at the front, which has a ensuite and a built-in robe. As you go through the corridor, you've got access into the garage, which has a laundry at the back, and then it also takes you through to bedrooms 2 and 3, which have their own individual built-in robes. There is a shared bathroom, so you've got a bathtub, a toilet, a shower, and a basin. And as you come through, you've got a kitchen, dining, and family as an open plan area at the back. These also have alfrescos under the main roof, so they're decent size alfrescos. And basically, you end up with 3 bedrooms, 2 bathrooms, a single living area, a garage for a car space under the main roof, and you also get a car space in the driveway. So it does accommodate for two houses, for two cars out the front as well. So basically, you end up with 132 square meters of home, and this particular property here will house whether it's a young family or a couple, or a couple of people living together. But basically, you're getting two houses built for under $600,000. Now, in terms of the location, just to give you an idea where Brassel or Ipswich is. Now, Ipswich is in the western corridor of southeast Queensland, and that is considered to be one of the fastest growing regions in the area. So, as you can see on my mouse, there's Brisbane CBD there, and this is the Ipswich region. Brassel is just north of Ipswich, and actually not too far off from the RAF base, which is one of the biggest employers in the area. So what I wanted to do is just sort of show you where exactly in Brassel is, or where this particular lot is. So inside Brassel, there's a new estate called Savannah Heights, and there is a big retail development happening in one of the later stages. So you've got a big Woolworth complex right here, and right next door to that is lot 344, which is the lot that we have picked out for this particular duplex. So as I've shown you, it's an 800 square meter lot. It will house two houses on there. Now, to get a duplex in Brassel or in Ipswich is actually very rare these days, because the Ipswich Council has put limits on how many duplexes and dual occupancy products we're allowed to build in those areas. So they have put a limit, and this is one of the very few that you'll find available on the market at the moment. So we are quite lucky to have access to this property. But for those of you who aren't from Brisbane and don't know where Ipswich is, or Brassel for that matter, this is just some facts on the particular area. So Brassel itself is, or Ipswich, let's say, is one of the largest cities in Australia. So there's about 70 suburbs divided into 12 divisions. And it's a fifth fastest growing city in Australia. So there's 89,000 new dwellings that are needed to be built by 2041. The Brassel itself is 7 kilometers from Ipswich, it's 35 kilometers from Springfield, and 46 kilometers from Brisbane CBD. Now, if you live in Adelaide, that obviously sounds like a lot, but in places like Brisbane, Sydney, and Melbourne, that's obviously a common thing. In terms of the population, there's just under 12,000 residents. Slightly more females than males. The economy is actually quite strong with a GRP of 11.77 billion with 115,000 local jobs. In fact, the employment population, over 90% of the population is employed, and mainly in the areas of construction, healthcare, retail, trade, and education and training. Now, from a housing point of view, there's less than 2% vacancy rate, so 1.88% vacancy. 43% of the area or the population there are renting. The median house price is about 380,000, and the median rent is 315,000. And I'll show you how that translates into the numbers that we work in to the forecast as well. So I won't go into the rest of it. Basically, it's talking about where all the major projects and the major infrastructure is. But in terms of transport, medical, education, shopping, and livability, it definitely ticks all the boxes from an investment point of view, particularly when you're looking for a rental property that's going to have consistent tenants. Now, for those of you who've asked me in the past, because I've had this question before, is that how do you generate equity out of a duplex? Now, as you can see from here, we're actually building 2 houses on one title for $599,000. Now, with a duplex, we actually have the ability to strata title these individually, meaning we can separate individual titles for each property, which then allows us to sell one off and keep the other, or we can sell off both individually. And by going through that process is almost like subdividing property, but you're subdividing it after it's built. So rather than getting a block of land, splitting it down the middle, and then building 2 houses, this is in a situation where you're buying a block, you're building 2 houses, and then you're subdividing, or strata titling, as we would refer to it. So in this case, if you were to subdivide and strata title these, basically we would get an increased valuation. So if we were to strata title these properties, basically we would achieve anywhere between $340,000 to $360,000 per dwelling if sold as individual dwellings. So the sales estimate on this is going to sit anywhere between 680 to 720. So we would be expecting on average about 100K equity uplift from this example. Now, if you were just to hang on to these properties and rent them out individually, we would be expecting between $300 to $320 rent per week per side. So you'd be looking at $600 to $640 worth of rent per week. And we've just taken an average of $620 per week. So estimating $610 rent per week, $620 or $310 per week each side. Now, this is the part where we like to look into, which is the financials, because as you know, we always base our decisions on the numbers. Now, in this example, I have worked out our, excuse me for one second. We've worked out our purchase cost at $599,990. Now, the purchase price and the market value, we've just kept them in line with each other. The building inspection, we've allowed $350. As you know, when you're building property, even if it's brand new, you still want to make sure that it checks off. The settlement costs, for those who are wondering how much money do you need out of pocket to be able to complete this transaction, you need a 10% deposit as a minimum as an investor. So we're working on just under 60 grand. Stamp duty is actually quite cheap because it's only calculated on the land, and Queensland's rate on stamp duty is cheaper than South Australia. So we're looking at just under $6,000 worth of stamp duty. And in terms of legal fees, for conveyancing costs, you're looking at spending a little bit more in Queensland. So it's usually about $1,300 on average for conveyancing, but we've allowed $1,500 in there for the cost. So all in all, you're going to need about 67 grand, assuming that, you've got you can get the loan at a 90% LVR, which most lenders at the moment are going up to 90% on investment. Now, in terms of setting up the loan, we've obviously allowed $400 in there for setup fees, and for our improvement and selling costs, I'll come back to the improvement in a second, but the agent's selling commission, so if you decided to sell the property down the track, you'd need 2.2%. For advertising, we've allowed $3,000, and for legal fees, we've allowed $1,500. So these are your exit costs. Now, in terms of the improvement to the value of the property, as I mentioned before, when you go through the exercise of strata titling a property, what that means is you're adding value to those properties by creating two titles rather than just one. And by going through that exercise, as I showed you in the sales appraisal, it means that we're adding about 100 grand worth of value to this property because we're doing a development approval on a property that's already built. So the way it works is obviously the other way around. You're not dividing first and then building, you're building and then dividing. But either way, you're still generating that equity uplift. And I'll show you how that translates into the figures once we go through the forecast. Now, from an annual income and expense point of view, I have worked on the average of $620 rent per week, and we've also allowed 2 weeks vacancy, although we've never had any issues with getting properties rented out really quickly in Queensland. So, 2 weeks is fair and reasonable for vacancy, which means this translates to $31,000 of rent per annum. Now, in terms of our expenses per year, our council rates are going to be calculated on two properties. So we've allowed $3,000 a year in council rates, which gives us about $1,500 per year per property. And we've also allowed $1,600 a year on insurance. So this will be building and contents, which works out to be $800 per property. Now, in terms of body corporate repairs and cleaning and service and garden and lawn maintenance, that's not applicable because you're not buying in a strata where there's going to be ongoing service contracts involved. However, in terms of a letting fee every year, so every time you relet the property, you're going to allow $620, which is usually 1 week's rent that you would need to allow for your property manager. And in terms of property management rates, usually we achieve about 7.7% in Queensland. However, we're working on 8% for this example. Now, when it comes to the loan structure, as usual, I've set this up on an interest only so I can show you the raw numbers. If you want a principal and interest example, let me know and I can work that out for you. The loan term is done over a 30-year period. The loan amount is a 90% lend, so you're borrowing $540,000 against a $600,000 property, which gives you a 90% LVR. And the interest rate at the moment obviously can vary from bank to bank. I've worked on 3.5% as the average because interest rates are really, really cheap at the moment. And look, that can vary from lender to lender, how much deposit you put, what security levels you're at, and how much debt you have. So I'm going to work on 3.5 as an average for this example. Now, in the last section, which is our tax and market factors, our depreciation schedule, again, is calculated over two properties rather than one. So in our first year, we've got $16,000 worth of depreciation, and we've put that on a sliding scale, which means it drops down incrementally over that 10-year period, but you're going to end up with more than $7,000 worth of depreciation every year moving forward. But I've just been conservative with those figures a little bit just to make the numbers sort of work a little bit better. So obviously if we can under promise and over deliver, that would be better than saying that you're going to get more depreciation and you end up getting less. In terms of the market factors, look, obviously we allow 3% every year for CPI. So costs of living and costs of doing business increases year on year by 3%. So what we've done is we've allowed just a little bit more on the capital growth. So CPI plus 1%, giving us a 4% capital growth. Now, usually in other videos, you may have seen we usually allow about 5% in most areas that are closer to capital cities. In areas where we're further out from a capital city, we generally go a little bit less. Look, a place like Ipswich has been going through some good growth over the years, but because of the supply levels of properties out in the area, we're not expecting a huge amount of capital growth, but we're still expecting some reasonable amount of growth. So still allowing that 4%. And in terms of the taxable income, we're basing this on the average situation of our clients who typically are earning around $85,000 on average. So obviously we've got clients that are earning much more than that, and we've got clients that earn less than that, but as an average, $85,000 seems to cover it. Now, when we look at the scenario report, this is where the numbers start to help us see what this property will do over the long term. Now, with this property at 599, so we're purchasing at $600,000. By the time we come to do our strata titling and we add $100,000 worth of capital growth to this property, that and your 4% capital growth, that's going to put us at around 723. Now, if this property continues to achieve a 4% capital growth rate over the years, that means in 10 years' time, we're going to end up with two properties that will be worth about $1 million collectively, which we purchased for 600. So that's about a $400,000 capital uplift over 10 years. So if you average that out, that's $40,000 a year. If you break that down weekly, that's $800 a week that you're making passively in capital growth that you're not having to work for. Now, in terms of the loan and equity position, I'm going to change this to a 90% LVR because that's where we're starting at. Basically, what that means is in the first year, you're starting with $60,000 worth of equity, which is the deposit that you put in. But by the following year, you're sitting at $183,000 worth of equity, which means you're sitting at a 75% LVR. If you wanted to refinance and redraw your loan back up to 90%, that's going to free up about 111 grand worth of equity that you can use on another purchase. So it's definitely a good property to use as a way to manufacture equity, which allows you to then invest in further opportunities. And as you can see, year on year, as the value goes up, it frees up more equity to then do further developing down the track. Now, when we look at the third section down, which is the rental income, again, based on that $620 rent per week over 50 weeks of the year, we're expecting $31,000 worth of rental income. Now, that translates to a 5.2% gross yield and a 3.9% net yield. So all in all, we've got 31 grand coming in. In terms of our expenses, look, we're just under $19,000 worth of interest costs, and you got about $7,700 worth of property expenses. So that means you're going to have about $26,500 or just under $27,000 worth of expenses. So you got $27,000 going out and you got $31,000 coming in. That means that before tax, this property is actually going to be positive cash flow by $4,400 per year, which is $85 a week, right? Now, in most cases, if this was an established property, you won't be able to, you'd have to pay tax on that money because you don't have any other benefits to reduce your tax. But because we've got depreciation benefits, this is what we would normally be able to claim. However, we've made a profit, so we can't claim all of the depreciation. We can still claim about just under $12,000 worth of depreciation. So when you take that off your taxable income or the taxable income of someone earning $85,000, that means they would receive a refund of $4,000 for that year. So that refund, that after-tax cash flow plus the pre-tax cash flow means that this property is now positively cash flowed by $8,422 per year or $162 a week. So again, for those of you who know our strategy, obviously we're looking at three main things. We're looking at capital growth. How do we increase our equity? And in this example, we're going from $600,000 to $1 million over a 10-year period. So we're making 40 grand a year in equity uplift, which is $800 a week in capital growth. We're also making a pre-tax cash flow. So before you submit your tax return, this property is going to put $85 a week after paying its costs back into your pocket. And after you do your taxes, you're going to get another further $4,000, which means now this property is making you a positive cash flow of $8,422 per year, so $162 a week. So again, we're looking for three things. We're looking for capital growth, we're looking for a good yield, which gives us cash flow, and we're looking for tax benefits. And this property ticks all three for us, and which is why I'm happy to do this video and recommend this as an investment opportunity. Now, we've had clients doing investing in duplex properties over the years. In fact, I've had clients from Sydney, Melbourne, and Adelaide all invest in these duplex opportunities, and we've had some phenomenal growth across multiple properties over the years. Brassel is an area that we have invested in the past, and we know what the market's doing out there. So again, happy to recommend this property as a good investment opportunity. For those of you who want to find out more, or you want to look deeper into the finances, or you want to run through numbers or do any kind of scenarios around your situation, feel free to reach out, let me know, and we can make that happen for you. So as always, I hope you got some value out of this video. If you have any questions, please feel free to reach out, and I will see you on the next video. All the best and take care.